I would like to talk today about why I think we need to be selling options instead of buying options. So I'm showing you the screen from Options Alpha, which shows a CME study from 1997 to 1999, which shows that 76.5% of all options held to expiration expired worthless. What that means is that somebody bought those options, call options or put options, thinking that they would appreciate in value. However, the extrinsic value of these options expires as time expires, and at the time of expiration, 76% of them went to zero. So, in my opinion, selling options is a better deal because we are selling insurance to people when we are selling puts, and we are selling speculation, so to speak, to people when we are selling calls. So let me explain. Let's say Apple today is at like 260 price. If I sold a 250 put for next week, what I am obligating myself to do is that I will buy Apple from you at 250. So big portfolios, big funds, they need to buy downside protection. So they would buy that protection to cover their downside by buying insurance. For the privilege of selling them the insurance, they would pay me $500 per contract or so, because one contract would cover 100 shares. By using margin in my trading account, I will have to pledge 20% of the cost of the option, so around 260. So I will have to put up $3,200, and if I get $500 of credit, I will be able to make $500 from the $2,600 that I put at risk. If at the time of expiration, the price of Apple is even 1 cent over 250, I have no further obligation to this trade, and it expires in full profit. In the scenario that Apple does fall below 250 at the time of expiration, I have two choices. I can either buy Apple at 250, which is actually $10 less than what it was a week ago, or I can roll my option. And because option prices also have the extrinsic value of time, if I roll my option 1 week or even a month in the future, I can normally roll to a lower strike. So I can go from 250 to 240, which obligates me to buy Apple at 240, which is $10 less than the price right now. And I can do all this for a credit. So basically, I can keep doing this, and I can keep collecting credit. So eventually, when I do get like the shares of Apple assigned to me, my cost basis will be much less. So this is why I believe we should sell options, and in this example, that would be the put option. So what about call options? So basically, if Apple is now trading at 260 and I sell a 280 call, basically what I'm saying to somebody is that if Apple goes above 280 at the time of expiration, I will sell them 100 shares of Apple at 280. And for this, they will pay me $500 for 100 shares or so for a week. If I believe that Apple will not go there, this is safe. You can sell that at a 20 delta. You can sell that at a 30 delta, which basically means there is only a 20% or a 30% chance that this option would be in the money, which is very safe. As I was saying earlier, the best part about selling options is you have the flexibility to roll forward in time for a credit. So as long as the position is not too big, normally what I recommend is that every trade that you do, it should not be more than 1 to 2% of your total account size. So if your account size is like 1 million, one trade should not be more than 10,000. Similarly, if your account is $100,000, one trade should not be more than $1,000 to $2,000, which gives you the flexibility to roll these options indefinitely and keep getting premium. In this way, you can wait to buy the shares of a company that you really want to own, but you can reduce your cost basis so that you can buy these shares 30, 40% below the market price when you eventually get these shares. We at the Manifest Wealth Fund specialize in this strategy, in the fact that we are selling options on gold futures and on SPX options, and we are creating income by doing so. I look forward to talking to you some more about this in the future.